Hello and welcome to this special broadcast. India's GDP grew at 6.2% in the third quarter of the current year, that is October, November, December 2024. This 6.2 is in line with CNBC-TV18 poll, which also threw up a 6.2 number. The GDP numbers for the last two quarters have also been revised, that is Q1 and Q2 of the current year. With this, the government says, or rather the Ministry of Statistics forecasts FY25 growth to come in at 6.5%, which is a little higher than the 6.4% that it forecast on Jan 7th, when the first advance estimates came. But 6.5 is still a tad lower than what RBI had forecast. Their numbers stood at 6.6 when it was finally revised. So, well, 6.5 is a bit of a saving grace, a better number. But more importantly, the second quarter, which we thought was an abysmal quarter at 5.4%, that also has been revised higher at 5.6%. So it was a disastrous number, but not as bad as we thought. I think the more important numbers we need to note are the revisions of 23-24, the year before, and the revision of 22-23. Now, last year, we should have been very happy. We actually grew by 9.2%. The number that was earlier told to us was 8.2%. So drastic revision in the 23-24 numbers by 1 percentage point. And this is despite the fact that the even previous number, 22-23, has been revised higher from the earlier 7% to 7.6%. So across the board revisions, 22-23, a revision of 60 basis points, 23-24, a revision of 100 basis points, and a slight revision higher in the current year as well, from 6.4 to 6.5%. But the one number that we were all worried about, third quarter, as the poll said, 6.2%. With this, let me turn it over to the experts. Joining me are the former Chief Statistician of India, Dr. Pranab Sen. Also joining us today, Kaushik Das, Chief Economist at Deutsche Bank India, Abhishek Upadhyay of ICICI Securities Primary Dealership, and Rajani Sinha, the economist from CareEdge Ratings. Gentlemen, and Rajani, thank you very much for your time. Dr. Sen, you have been there, done that in terms of statistics. Should we be happy that the past is better than we thought? Or should we bemoan that 6.2 only? I mean, it would have been better if October, November, December were better than 6.2. What is your first reaction to the numbers?
Lata, if the past had not been revised upwards, the 6.2% would have gone up.
Yes, much more.
So, yeah, I think you should be happy.
Okay, that's well put, Dr. Sen. You're absolutely right that over a 1 percentage point increase, we have seen the number still come in at 6.2. So let me get to those who are looking at the nitty-gritties. Abhishek, pointedly, what about the third quarter numbers exhilarated you?
So, as was expected, the acceleration in the third quarter compared to 5.6 growth in the second quarter was mainly led by agriculture and government spending. So, government spending growth, it seems, has picked up quite strongly, above 8%. Agri growth is also, I think, above 5%.
Yeah, 5.6.
Yes, so which is a sharper acceleration compared to earlier growth, which was in the 2.7, 2.8 ballpark for first half. So these are the two main segments. Manufacturing growth also has picked up, but quite modestly. I think the bigger story, as you mentioned, is that there has been strong upward revisions to earlier numbers, which then indicates a possibility of upward revision to this year's growth forecast as well, because it is a sign that growth momentum was stronger as we headed into this fiscal year. You have to note that the growth numbers that we have got for this year are based on a different approach, based on the benchmark indicator approach. And these high base or volatility in the base for the earlier 2 years has not really impacted this year's growth. I would assume that growth in the first half of the year could have been somewhat stronger than what is currently penciled in, and therefore some scope for upward revision. Last point I will make here, Lata, is that the growth for the current quarter, the Jan-March quarter, is implied to be very strong as per GDP, above 7.5%. So possible this may not be realized, but you may still get a full year number which is in line with 6.5% or maybe a tad high.
Okay. If you subtract the 3 quarters from the full year forecast, we should generate a 7.5% growth in Q4, you're saying, which looks like a tall order. But let me take the first part of your answer where you agreed with Dr. Sen that we should be happy. Now, I have worked out the numbers. The Q3 of last year, we thought was 39.9 lakh crore GDP. But what we now discover is that it is 40.6 lakh crore. So good 60,000 crore more, in spite of the previous Q3 being, 60,000 crore more, we have generated a 6.2% growth. So Q3 is actually a number which the market and the economy should celebrate. Kaushik Das, your first thoughts. Do you think that we should expect more upward revisions, that this 6.5 is attainable, that Q4 will therefore be, a good 7% number?
So, Lata, first of all, there are different ways to look at this number. And as you mentioned, and Dr. Sen mentioned, that if the number stayed at 8.6 for October, December 23, which was the initial number, this number should have been above 7.5%. That's one way to look at it. But we know that the GDP data is, there's a lot of issues in it, and there's this element called discrepancy, and we have to figure out how this data have been calculated, revisions, all these factors. But bottom line is, even if the July-September number has been revised up 5.6, suppose it gets revised higher to 6%, it is still below the potential growth rate at 7% plus. And there has been a slowdown through FY25. No matter how you look at it, it doesn't matter what the GDP number sometimes the revisions are telling you. But the point is that the slowdown is in motion. October, December, the number at 6.2, whether it could have been higher or not, this is the number that we have at this stage. Policymakers will use this number to decide what to do, as far as policy actions are concerned. January, March, we could be at 6.5, 6.7. We've had the Mahakumbh, Mela, and for that, there could be some increase in GDP. Who knows? But I think the bottom line is that India's growth is about 6.5% this year and next year also, given the various risks that are there from the global, macro space. We would be comfortable to keep it at 6.5%. And therefore, growth continues to be below the potential rate of 7%. And therefore, you need policy actions to support that growth. Now, the thing is, we know that India's GDP deflator is not calculated in the way it should be. We give more weight to WPI. That kind of makes things complicated. The real GDP is artificially boosted at times. So all those factors have to be taken into consideration. But the broad view is that India is going through a cyclical slowdown. But the worst is behind us in July, September. From here, we should see incremental improvement going forward. But still, you will remain below the potential growth rate of the economy for some time. And therefore, you need some policy action from the RBI. And government has already done the tax cuts. So that will also feed into the real economy with some lag. And you'll see probably FY26 at 6.5% growth.
Okay. Well, that's a very no-nonsense way of approaching that even if it is not 6.4 but 6.5, we are still growing below potential, and there are, of course, headwinds. A rate cut and other kinds of help is called for. Rajni Sinha, before I come to the policy prescriptions, is there any standout number in the constituents that you want to speak about? Agriculture, I thought, was a standout number, but your thoughts on any specific sectors?
Yeah. I would like to highlight the aspect that if you look at the overall GDP number at 6.2%, it's broadly in line with market expectations. And it's also in line with our expectations. But I would say what the worrying part is that this growth has been mainly, agriculture growth is very high, like you highlighted. It's at more than 5%, it's turning out higher than what the market was expecting. But the concerning area is that manufacturing, which had shown a moderation in second quarter, and we were looking forward to seeing some improvement there the improvement has been very minor. So manufacturing sector continues to record weak growth. The other concerning aspect is that investment growth, which had, seen a sharp moderation in second quarter, and we attributed it to election-related uncertainties in the first and second quarter. And we were expecting investment to pick up in the third quarter. However, if you look at investment GDP, that also remains weak. It's broadly around the same as the growth recorded in the second quarter. So I would say while overall growth is in line with market expectations, I am concerned about weak investment and weak manufacturing growth.
Actually, that's extremely well spotted. The gross fixed capital formation at about 15 lakh crore is actually lower than what it was in the second quarter. Second quarter, if you look at the aggregate number, it is 15.4 lakh crore and it's dropped to actually 15.05. So this extraordinary big capex which the government gave in December doesn't seem to have moved the needle much, but who knows? In India, the past is uncertain. So we may get a different number next time. But for the moment, it looks like capex is in pain and it has not kept pace. But by the same yardstick, private expenditure has grown by 6.9%, which is an improvement over the first two quarters. Abhishek, you don't trust these numbers of, the expenditure side. Any comment at all? Would you say that consumption has picked up because we now have a personal final consumption expenditure of 6.9%? Should we be happy?
Lata, so Kaushik mentioned that discrepancies plays a big role, in GDP accounts. So, last year, full year growth, as we now know, is, above 9%. Private consumption growth would have been much lower. And this year, when growth has slowed down, private consumption growth on the GDP side shows a faster number. So I would not, look at that number closely, especially when making interpretations about quarterly data. Better to look at high frequency data there as well as the supply side estimates. What the high frequency data indicates is that there are signs, economy has turned a corner, both in terms of, discretionary consumption, looking at the auto sales numbers over the last quarter, as well as demand for consumer staples was also reasonably strong. Looking at surveys by market research companies for both rural areas and urban areas. Plus, one issue has been, GST collections, which are a good proxy, real-time proxy to gauge consumption demand, had weakened quite a bit after, double-digit growth seen in the earlier months of the fiscal. Between August and December, growth in GST collections was in single digits, but January again shows a higher growth there. So there are some signs, consumption demand is recovering, and you would assume that as inflation normalizes, it is possible consumption demand could become somewhat more broad-based. At the same time, it is difficult to expect a very strong growth there, given headwinds, again, from global side, but also tight domestic financial conditions, and a situation where banks still will not be extending credit in as strong a way as they had in the past. Okay.
Yeah, those are all the weaknesses. You were speaking about strong GST collections in January. We have some forecasts for February auto sales, and they are looking quite terrible. So I don't know what to make of the fourth quarter. I have to take a compulsory break, commercial break. I'll come back and discuss fourth quarter with my guests. Back in a jiffy.